Welcome back to the IB Investor channel. In this video, we'll take a look into the Swedish serial acquirer Teqnion, which is listed on the First North Stockholm. The company was founded in 2006 by Johan Stene and Vixar. The company has a market cap of 3.4 billion Swedish kroners, so it's certainly one of the smallest companies, or it is the smallest company I've made a video about so far. It did have a listing in 2019 for the first time. It has a tremendous growth so far. It's grown roughly 30 or 52% CAGR for the past 4 years, so very fast. What is also interesting with this company is that the famous author of the book 100 Bagger, Chris Mayer, is an investor in this company, and he's very famous for his ways of picking stocks. He basically wants to invest like $1 worth of price and hopes that the share price will go up to $100. That's basically a 100 bagger. The only big recent news about this company was a direct new share issue of about 175 million Swedish kroners that happened quite recently. And again, the interesting stuff here was that Chris Mayer and Spiltan Investment were some of the takers of the direct new share issue. Now this is a picture from my broker, so we can see the share price for the duration of its listing or being a listed company. We can see it's been just tremendous. The share price return has offered a 52% CAGR for the past 4 years, which is very, very strong. I think the 6RX has returned somewhere like 10% for the past 10 years, so it's very much higher than that. Even this year to date, the stock has returned, somewhere between 43 to 46% or something like this during today's trading. So it's done really well for itself for a long period here. But it did have some struggles when the company just recently listed here in 2019. They had some problems here with some acquisitions. So they only had half-year reports back here, and there was a long period where the company couldn't report its progress with those unlisted companies, or sorry, not unlisted, but the acquired companies that they had made. So they had some issues here because those acquisitions that they had made were done before the IPO, and they had to work them through here for a long period. And I can also mention during this period of stress, Spiltan Investment made some investments here, so they acquired some shares during this period of stress, and then management here managed to turn around those acquisitions that they had made before the IPO. And obviously here we can see that the stock took off as a consequence when management then were able to turn the company around and turn the company into profits again. So, and the rest is basically history, as we can see here, and the max here, the company has returned somewhere, 410% or something for the past 4 years, which is very massive. Unfortunately for the dividend guys, this company doesn't really pay any dividend if we check the history here. Obviously, it's still a very young company, but we can see that they made a slip here in 2021 and paid out a dividend at 0.5 kroners per share. But we can see here in 2022 and most recent 2023, the board has decided not to pay any dividends. So this is not a dividend stock at all right now. As we can see here on the graph I prepared, the company's free cash flow margins is it's basically over the place. You can't really make any trends out of this. Some years it's been positive, some years it's been negative, some years it's been very positive at 9.2% margins here, and some years it's been, going down. And actually quite recently in 2021, 2022, the free cash flow margin has been negative, but it has returned to positive here in the most recent quarter here up until now. So it's very volatile, and investors can't make any predictions where the margins will be next year based on the historical numbers, because it's just jumping too much up and down, unfortunately. Now for this picture, we can see the free cash flow per share for the past periods, and yeah, just like the free cash flow margins on the previous picture, this paints pretty much the same picture when the free cash flow per share is being all over the place. It's very difficult to predict, and some years or several years in a row it's been negative, and some years it's been positive here with 3.2 kroners a share, and then some years again it's gone down 2.8 kroners a share minus, 2.2 kroners a share minus, and then this most recent quarter here we can see that they posted a 4 kroners per share free cash flow. So again, very difficult to predict where this is going to go. I mean, for the next year it could be negative again for 2 years in a row, and or it could be positive. You, investors can't make any predictions when it looks like this. Here in this picture, we can see the enterprise value divided by the operating cash flows and see how many times then we're paying for this company. And we can see here it trades currently at 29.5 times, so it is quite expensive. And as we can see here, the trend has gone up past or for the past few years, which is not good for investors looking for value, obviously. But this is the short term. You have to remember all the time that this is the short term numbers when you look at this. But we can also see comparing it to its peers. So AdTech and Indutrade are also serial acquirers that are looking for niche businesses, very much similar to Teqnion. And we can see here that AdTech trades at much lower multiples here, at the enterprise value divided by operating cash flow at 19, and Indutrade at close to 24. So quite a big difference you're paying up for this company. Now looking at the EV to EBIT, or enterprise value to EBIT, we can see that it's been trading pretty much at the same levels, I would say, for the past few years, from 2020 up until the most recent quarter here, at roughly 19 to 20 times or something like this. We can also see I made some comparison here to AdTech that trades at 20 times, and Indutrade also 20 times. So it's very similar to its peers actually. I wouldn't say that this is necessarily cheap or expensive, but it trades at 19.8 at least in the most recent quarter. Now looking at the profits or the gross margins here right now, and we can actually see that the gross margins are actually quite good. I would say I would even go as far as to say that they're actually quite impressive. You got to remember that this is an industry company, so it's not like a tech company or something like this. But even for an industry company, a gross margin at 46.9, that is pretty good, I would say. We can also see here, comparing it to AdTech's gross margin at 30.8 and Indutrade's at 34.6. So even versus peers, their gross margins, or Teqnion's gross margin, is actually quite good. And we can also see here that the history has been good as well. So for the past many years, we can see that it's been pretty good. And I'm not sure whether this is because of acquisitions that they made, that these acquisitions have had higher gross margins and pushing it upwards because it's been lower in the past. But seeing that this has been the case for many years, I'm not so sure. I think they've done both, a bit of both acquisitions that have good gross margins, but also probably worked within the management that they have for the companies and pushed prices upwards. So yeah, gross margins look pretty good, I would say. Looking at the operating margins here, we sit at almost 12%, or just shy of 12%. And as we can see here, if we're comparing it with peers first, it's lower than Indutrade's and just shy of AdTech's here, 12.1, so very close to AdTech, but it is lower. And we can see that the operating margins has been, historically at least, it's gone up here as of late for the past few years, so that's good to see. But we can also see that the operating margin has been higher in historically speaking, but 11.7, I mean, it's pretty good, I would say. And lastly, when we look at the profit margin, we can also see here that it sits at 8.5%, which is actually higher than AdTech's 8.2, but smaller than Indutrade's 9.5. And the profit margin here has for the past at least 2 years been quite good, I would say. I mean, you got to remember all the time that this is an industry company with probably a lot of competition and so on. So these profit margins are pretty good, I would say. And we can see that the profit margins has been lower in the past. So management has been doing a good job here defending the margins and pushing them upwards. So yeah. Now looking at the debt situation for Teqnion. So it currently has a net debt to EBITDA at 0.53, which is quite good for the most recent quarter here. We can see it has been higher in the past, 1.4, but it's not been the lowest we've seen here historically. It's been much lower, but 0.53 is still a good number. And we can also see here comparing it to peers here. AdTech sits at 1.5 times, Indutrade at 1.9 times. So I would say management do have plenty of room here to make further acquisitions or invest in their own business, because 0.53 it's low. I mean, it's not negative, but it's low. Now for the return on invested capital, just to see how management has done in the past, and we can see that they produced a 17.4 return on invested capital right now in the most recent quarter, and it's been pretty high for many years. Obviously, it's been higher in the past, but you got to remember that during this period the company was much lower as well. So yeah, they probably had some better possibilities of making good acquisitions, for example, or drive good improvements while the company was still small. But a 17.4% is still a respectable number, I would say. And comparing it to peers here again, with AdTech sitting at 16.6, we can see that they're beating those at least, and the Indutrade only sits at 12, which is actually lower than I would have imagined. I haven't looked for this number for a long time, but it is lower, much lower. So Indutrade's number is low, and as we can see here, Teqnion's is 17.4. So management has done a good job here at allocating capital here for this company. Now for some risks for the company. There's always risks in every company, and I want to point out the high margins here versus peers, which is obviously to its strength right now, but I'm not sure whether or not these margins are sustainable, because sitting at 46.9% gross margins are quite high for an industry company. Even though it might be, you know, specialized in producing niche products, it's still a very high margin, I would say. So the risk here is, of course, that management will not be able to defend those margins going into bad times now, especially with cost inflation, you know, increasing the cost of goods sales quite a lot, I would imagine, especially for a company with like industry margins or industry gross margins. They're going to be hit much harder with cost inflation on the bottom line. We also see that the company trades at quite high multiples. And again, I mean, in the short term, any company can look very expensive, and especially Teqnion that trades at quite high multiples at like almost 20 times enterprise value through EBIT. But you got to consider that this company grows very fast, so it could be the case that investors want to pay up for this and, you know, take some short-term pains. But you have to remember, at least the metrics that I shown in this video proves that this company is quite expensive in the short term. Teqnion is also quite a like young company. It was founded only in 2006, and the IPO just happened 4 years ago. So it doesn't have a very long track record to go on. And we've also seen, you know, that the free cash flows and so on has been very volatile over this period. So, you know, it could scare away some investors. It could attract some others. I'm not sure, but it's just something to remember at least. Now for the upside of the company, and I think the most important thing here that I want to highlight is the highly motivated management, and especially the CEO, John Stene. He's very inspirational as a leader, and I think he might be able to inspire many of his direct reports with this type of leadership that he's shown so far. Teqnion also has very strong owners, such as Chris Mayer and Spiltan, who came on board after the IPO. Spiltan has been here for longer, but Chris Mayer came to the company quite recently. And Johan Stene, also the founder of the company and the CEO, owns roughly 6% of the capital, along with Vixar, the biggest owner, that still holds roughly 32% of the capital. Teqnion is also a quite small company with only a market cap of somewhere between 3.4 or 3.5 billion Swedish kroners, depending on how the trading ends today. So there's plenty of room to grow before it becomes a big whale in the market, which obviously gives this company a long leeway. Looking at the debt situation, which I think is an upside, at least it depends how you view it, but the company has a low debt, net debt to EBITDA that sits at only 0.53 times. So that means that management has the possibility to make plenty of acquisitions if they want. They have much room for that in the balance sheet, and they could also keep growing the business and invest a lot within the business without the debt situation spiraling out of control here. And obviously they were able to make a direct share issue here at quite high prices as well. So it looks like the institutional investors are ready to jump on board if this company would ever need some money. So that's certainly a strength that I see it. This was it for this video, the Teqnion company. Thank you very much for listening and watching this video. If you liked the video, please like and subscribe for more content. Thank you very much. Bye bye.